The chip index fell about 10% in days in June. The nuclear stocks that had tripled fell back 30%, and the quantum names were cut almost in half. And the AI trade looked like it was finally coming apart. Then Micron reported quarterly results with revenue up 346% year over year, the best gross margins ever near 85%, and their most advanced AI memory sold out through 2026, with the shortfall continuing through 2028. Those are the telltale signs that the AI build-out is really starting to accelerate, not a bubble starting to cool off. So those are the top stocks I'm watching now. Best companies in that whole build-out that got dragged down with everything else and have the most room to grow now. And then, at the very end, I'm going to show you exactly how I'm going to size each and every one of them. The first name is Eaton, the power management company that does just about everything an electron passes through on its way from the grid to the server. The transformers, the switchgear, and the backup power that keeps data centers alive. And here's the number that turns the whole company on its head. Every megawatt of AI compute that's built, it's about $3.4 million of electrical content at Eaton. The industry is expected to build some 13.6 gigawatts of new data centers alone this year. That's something like $46 billion of electrical equipment on the table for 1 year of construction. And the entire company at Eaton did about $27 billion in sales last year. A year of data center build-out opens up a market larger than the entire business was last year. And we're already seeing that play out with Eaton's data center orders up some 240% from a year ago. And it has almost a year's worth of sales backlog. Then there is the part that looks scary until you look closely. The headline operating margin dipped to around 15% in the last quarter. The business is starting to look as if it might crack. But that was the price of the acquisitions Eaton was making. The core electrical business had a margin of 22.7% and record-adjusted earnings and raised guidance above that. The real story is then you have to back off the transformation. 6 years ago, Eaton was an industrial company with $21 billion in sales and a 13% margin. And today, it does over $27 billion at just under 20%. Thus, revenues increased, but profit almost doubled its overall margin. Now, that comes at a premium price, and a pullback like we just saw is the chance to begin building the position. The second name of power we now turn to is BWX Technologies, and this is the only nuclear stock I would actually buy on this dip, because it's the only profitable one in the group and the only manufacturer of the reactors that power every U.S. Navy submarine and the aircraft carrier. So when the nuclear was sold, the gap was rapid. The hype pure plays like Oklo and NuScale fell about 30%, while BWXT gave back only about 17% from a base that had been climbing during their decline. And the reason why is simple. The other pure plays are years away from their first one. BWXT builds reactors and gets paid for it. BWXT is doing, and the rest are still betting they're not quite there. But the Navy is just a base at the moment, as BWXT quietly runs 4 different nuclear businesses all under one roof. They're building the first reactor pressure vessel, the largest part of one of the first small modular reactors being built in North America. It also makes TRISO fuel for Kairos Power, which is building a reactor to help power Google. Its medical arm makes isotopes for treatment of cancer, from liver tumors with Therasphere to one of the largest being manufactured today with Actinium-225. So you get the monopoly on defense, a piece of the nuclear renaissance, an AI power supplier, and a cancer treatment business all rolled into one. And their work is rock solid because BWXT carries a record $8.6 billion in backlog, up 77% in a single year, versus a company that does under $4 billion in revenue. So it's got over 2 years of work in the bag already. And you can see the flow through to cash because free cash flow was about $46 million in 2023 and almost $300 million in 2025. And it's rising again this year. The only real catch here is valuation, as it's near 43 times forward earnings on a low double-digit grower. So it's not quality, it's entry that is the question. That's how you get better entry points, the kind of pullback we've seen the last few months. Now we come to the chips, and the first name that everybody expects is NVIDIA. The real monopoly that is missing is from the software, not the chips. NVIDIA wrote CUDA, and it is the platform for everything AI. It has some 6 million developers building on it and more than 1 billion of its chips in use around the world. And lock-ins are something no other competition can really break. But what makes it a monopoly in several fields at once is that NVIDIA essentially plays the same game everywhere. It doesn't sell a single chip for data centers. The entire rack is sold as a single computer. And its networking division alone grew from almost $20 billion to almost $60 billion last year. And in robotics, it develops the platform on which humanoid robots are trained and operate on a daily basis. In quantum computing, it is also building the software that runs on those machines, with 17 of the top quantum hardware makers and 9 national labs already connected to NVIDIA. So whoever wins AI or whoever wins robots or whoever wins quantum, they all still have to pay NVIDIA. And then there's a number that really gets my attention, where revenue grew by a factor of 8 in 3 years from $27 billion to more than $215 billion. And the stock got cheaper as it went up. Its PE ratio fell from over 100 to around 30. This happened because the earnings were rising faster than the price, and that is the reason why the PEG ratio, specifically the price you pay relative to the speed at which earnings are growing, is around 0.5. And anything around 1 or below means the stock is cheap for its growth. Then consider the other side of the trade with Broadcom, because everyone is paying for NVIDIA. They call on Broadcom to stop paying it. Strange. When Google or Meta or OpenAI or Anthropic wants to build its own AI chip so it can get out from under NVIDIA, it co-designs that chip with Broadcom. And Broadcom sells the networking that connects those chips as well, so it gets paid twice for the same cluster. And that AI business is accelerating, not decelerating, because its AI revenue grew over 140% last quarter alone. The figure is expected to almost triple this year. That put it on track to nearly double again the following year, all with a $73 billion order book behind it. That's why that one line is now nearly half the company. And the VMware deal that everyone thought would be a burden for the company, it did the exact opposite. VMware software has a higher margin than Broadcom's own chips, 77% versus 58%. So in fact, it lifted the blended margin. So while Broadcom looks expensive at around 60 times earnings, that is the VMware accounting hiding the real number, because it's trading at a far more attractive 24 times next year's earnings, with a PEG of around 0.5. And that's as cheap as its growth is, NVDA. So after the pullbacks we've seen back down to its 200-day line, that's my entry into the arms race of the whole AI chip war. Which brings us to Alphabet, the cheapest and most beaten down of the megas. Build their own chips, TPUs, so they don't pay the NVIDIA tax that the rest of the industry pays. And on top of that, it's building its own Gemini models. What you need to understand about Alphabet is that it truly is for companies moving at very different speeds. Search is the cash cow, still by far the biggest piece, and far from dying, its growth has almost doubled over the past year, from 10% to 19%. When AI mode hit 1 billion users, it started monetizing questions it could never monetize before. The new rocket is Google Cloud, where revenue soared 63% and the operating margin almost doubled in about a year and a half, 15% to 33%. So what was once a loss-making unit has now turned into a serious profit engine, and customers have already booked about $460 billion of future cloud work. It has a backlog bigger than the annual revenue of all of Alphabet. And quietly, secretly, YouTube has become bigger than Netflix, the most watched service on American televisions. But Waymo isn't letting you take a ride on this one for a free call option, already doing more than 400,000 paid robotaxi rides a week. That's about 10 times what it was. So again, it's 4 engines, and the fastest, highest margin ones are taking a bigger slice every single quarter. Something to note is that last quarter's profit appeared higher than it was. This was helped by an investment that had a one-off paper gain. So if you take that out, the real earnings are just a little bit lower. However, it is the cheapest mega in the group, with a valuation of approximately 24 times forward earnings and a PEG ratio of around 1.3. The most oversold name in this group is the one that experienced pullbacks over the last few weeks. Yeah, it's slowly getting off the ground, but still has a long ways to go, and this is where I like to see it. Another of the mega anchors is Arista Networks, the company that makes the high-speed switches that wire all those GPUs together inside an AI data center. But its real advantage is software like Broadcom and Google, because every Arista switch in a campus closet or giant AI spine runs the same single operating system, and that's why the cloud standardized on it. For years, GPS had to talk to each other using NVIDIA's proprietary InfiniBand, but now the entire industry is moving that function over to Open Ethernet, which is Arista's home turf. Meta demonstrated it could be done, running a cluster of more than 24,000 GPUs on Arista Ethernet and InfiniBand. And that's why Arista doubled its AI networking revenue last year and is guiding to do even more this year. And a big part of that demand is already prepaid, with customers paying Arista prior to delivery. And that deferred revenue has more than doubled to over $6 billion on the books. Underneath is a fortress, as revenues almost quadrupled in 6 years and operating margins actually grew from 30% to 43%. Zero debt and net cash over $12 billion. Gross margin appeared to drop over the year from 65% to 62%, but for the full year, it was dead flat at 64%. Same as last year, when low-margin cloud orders are heavy, the mix drops by design. The only real problem is the price. Its peg is close to 2 as it's trading near 44 times forward earnings. This one is the richest of them. And the market certainly made that point when Arista beat and raised guidance, yet the stock still fell. So this is one of all the megas where price matters a little bit more. So I'm looking for more pullbacks because I want it around that 50-day line where buyers tend to really step back in. And now we're going to turn around and go down into the small caps, where the risk and the reward both go way up. So we're going to start by introducing Rambus, the shovel salesman, into the world of memory. Each AI server requires some traffic control chips for every high-speed memory module. Rambus handles the entire process, led by the conductor chip known as the RCD, in what is essentially a 3-company collaboration. So it's based on the memory in the AI build-out, no matter who the manufacturer is that's going to win. And the business underneath is fundamentally different, as Rambus was a money-losing patent licensing shell 10 years ago, and now it is a profitable chip company, debt-free, with an operating margin swinging from negative 38% to positive 37%. And there is a twist that goes the other way than you would expect, because Rambus is paid per module shipped, not per price of memory. So when memory goes into shortage and prices spike, which is good news for Micron, fewer modules actually ship, and Rambus can feel that as a headwind. And that's why that's one of the highest risk names on the list. It's trading at nearly 60 times earnings now with a multiple well above 2. And it's working through a few overhangs in mass. It is responding to a request for documents in a Justice Department investigation in which it is neither charged nor a defendant. A securities investigation is not a lawsuit. It is a law firm looking for plaintiffs, and one chief financial officer who departed earlier this year. Although the company claims there was not the slightest disagreement, it is clear that there were significant issues. So this is a small, high-risk position, sized down on purpose, and only worth it on a real pullback like the ones that we've been slowly getting here and there. Now, on the optical side of the build-out, there is Fabrinet. The whole basket contains the cleanest picks and shovels. This is because Fabrinet is the physical factory that makes the optical parts that move data through AI networks, the transceivers that connect the GPS to the switches within a data center. It builds them for Cisco, NVIDIA, Coherent, and Lumentum. So it wins regardless of what brand is on the box. And customers can't just walk away easily because it takes many years to qualify the alignment of lasers and fibers to within a fraction of a human hair. And when a program has been certified in Fabrinet's clean rooms, it is slow and risky to move it. Its data center interconnect business grew 90% year on year. And the real limit on that is not orders, it's capacity. The demand is far greater than what it can physically construct. Hence the frantic scramble to build a huge new plant. It is a low-margin business by its very nature. The customer owns the designs. So don't look at the 12% gross margin and expect a whole lot more. Other areas show the quality. Operating margin went from below 8% to almost 10%, and revenue more than doubled in 6 years. And it produces about 20% on its capital with no debt. The problem is it is small and it is concentrated, about half of its sales. This includes products from NVIDIA and Cisco. Even with a 30% pullback, it's not exactly cheap with a peg around 1.5. So this is the small higher risk end of the optical trade sized accordingly, and a pullback like the ones we've seen makes the entry work a little bit easier. So it's going to be very heavy on the mega caps all the way down to the small caps. So the little bets, if they work out, are good, and if they don't, well, they don't pull the whole thing down. Please subscribe to this channel, and as always, thank you so much for watching.